In this session, we're going to discuss counter trend line breaks, as well as short-term pullbacks and long-term extensions. We're going to utilize this uptrend. The market is making higher highs and higher lows, and the market is pushing up. Now, what happens when a trend begins? Well, first is the extension. The market's going to push up, and then comes the retracement. What a retracement is when the market has 1, 2, 3 candlesticks, which are bearish, that are bringing the market down. Now, the 3 candlesticks, which are bearish, do not have to be in a row. Notice how you have 1, 2 bearish candlesticks, followed by a bullish, followed by a bearish candlestick, but the market did fall. Now, this is known as a short-term retracement. You're going to bring in a hand-drawn trend line, which is going to be laid across the tops of those candlesticks, which is monitoring the short-term pullback. Now, this is also known as a counter trend line, and the reason why it's called a counter trend line is because the overall trend is up and your hand-drawn trend line is going down. If the market is able to close above your counter trend line, it's known as a counter trend line break. And it also signifies that the short-term retracement is over and the long-term extension is starting to take place. It is a fantastic time to enter into the market buying or going long. Now, notice how the market begins to extend going up until you have 1, 2, 3 bearish candlesticks. Now you're in a retracement. You bring in your counter trend line, and if by chance the market closes above your counter trend line, it is an optimal entry or optimal area to enter in the market buying or going long. Then the market extends, and you can repeat this process over and over and over again until the trend ends. Let's go ahead and take a look at the same examples, but inside of a downtrend. In this scenario, we have the market making lower lows and lower highs, lower lows and lower highs. First, the market will establish an extension, or the market will push going down. This will maintain its position until the market has 3 bullish candlesticks, signifying a short-term retracement. Now remember, your 3 bullish candlesticks do not have to be in a row. So we'll bring in a hand-drawn trend line known as a counter trend line, and if by chance the market enters or closes below your counter trend line, it is a fantastic area to enter the market selling. When you enter the market selling, your extension should take place until the market begins to pull back once again. Bring in your counter trend line, and if the market closes below it, enter the market selling once again and enjoy the extension. Let's go ahead and take a look at very similar examples, but inside of the live market. So in front of you is the euro against the US dollar on a 4-hour time frame, and the market's making higher highs and higher lows and pushing up. The overall trend is bullish. We're going to apply hand-drawn counter trend lines to help us identify the opportunities to enter in the market buying, and also to help us understand if the market's in a short-term retracement or in a long-term extension. Notice how this market has 1, 2, 3 bearish candlesticks that are bringing the market down. What I'm going to do is apply my hand-drawn trend lines over the wicks of those candlesticks, and I'm going to wait for the market to close above my hand-drawn trend line. Now, notice how the market closed above my counter trend line. This is the optimal time to enter in the market long or begin to enter in the market buying. This also lets me know that the short-term bearish movement is over and the long-term extension is starting to take place. Notice how the market begins to push up. Now, the extension will maintain itself until you have 1, 2, 3 bearish candlesticks. What we're then going to do is apply the same exact steps. We're going to bring on our hand-drawn trend line, which is also known as our counter trend line, and we're going to place it across the wicks until the market is able to close above the counter trend line. Now, when the market closes above the counter trend line, we will enter the market buying. Now, we want the break of the candle to be a bullish candle. So if the market opens on the opposite side, doesn't necessarily mean we're going to buy the market. We want the market to close with a bullish candlestick. In this scenario, you can see the market closed above the counter trend line, and it's time to enter in the market long. The market then begins to push up, and you're inside the extension until you have a retracement. Now, notice how we have 1, 2, 3 bearish candlesticks. You bring in your counter trend line, and in this scenario, you can begin to see that when or if the market closes above the counter trend line, it is the optimal time to enter in the market long or to buy the market. Look how the market begins to extend. Now, if we fast forward this, you can begin to see over and over and over again how counter trend lines can really assist you and help you find fantastic buying opportunities. Here's a counter trend line break, there's a counter trend line break, and there's a counter trend line break. Let's go ahead and take a look at very similar examples, but in a downtrend. So in front of you is the Great British Pound trading against the Japanese yen on a 4-hour time frame. And notice how this market has 1, 2, 3 bullish candlesticks. In this scenario, they are in a row. What I'm going to do is apply my counter trend line. It's just a hand-drawn trend line that monitors the short-term movement. The overall push should be down, and so my counter trend line will help me understand when the short-term movement is over and when the long-term movement extension should begin. It's only when the market closes below my counter trend line is when I will begin to take action and look to sell the market towards the south. In this scenario, I would have entered in the market selling. Now the market is starting to extend. Now the market will maintain this extension until I have 1, 2, 3 bullish candlesticks signifying a retracement. Then I will bring in my counter trend line once again. Now notice how I'm placing my counter trend line across the lows of the wicks as well as the bodies. It's only when the market closes below my counter trend line, which signifies that the short-term movement is over and the long-term movement is starting to begin. So I enter in the market selling, and then the market begins to extend. Now the market will maintain this extension until we have 3 bullish candlesticks. Now 3 bullish candlesticks do not need to be in a row. In this scenario, you have 1, 2, 3 bullish candlesticks in a row, making it a little easier to understand the retracement. I'm going to bring in my counter trend line, and if by chance the market is able to close below my counter trend line, I'll enter into the market selling. Notice how the market closed below my hand-drawn counter trend line, and I enter the market short. And then the market should extend and fall down towards the south. Counter trend line breaks are a fantastic way to understand when a short-term movement is over and a long-term movement is starting to take place. It is also utilized as an entry strategy with giving you the opportunity to enter into the market, selling, or buying with avoiding drawdown. Trends and trend lines. The trend is your friend until it bends. In this lesson, we discuss how to appropriately apply your hand-drawn trend lines. Now, whether the market is making higher highs and higher lows, or lower lows and lower highs, trend lines can help you identify market direction. Now remember, specifically, trend lines help you identify 3 things: buy zone, sell zones, market speed, and market opportunities. We also discuss ABCD wave movements, and as well as how you can utilize counter trend line breaks to help you find optimal entries. Now, when it comes down to placing a trade outside of equity management, finding direction is the most important aspect to being a great investor, and trend lines is a fantastic place to start.